So we have two major issues that will directly impact the market, and that is war and Trump. Both have unique considerations that we need to factor into our decision making. So let's dive in. My name is Brian Cannon. Welcome to Markets in 5. All right, we're going to jump into a chart of the S&P 500, and we've been looking at this chart for a while, but essentially we were in this consolidation zone where we had all these gains, and then the market kind of levels off, and that's very natural, where the bulls are trying to take it up, but the bears will pull it down, and it just kind of stays in this tight range until it doesn't. And so it broke to the downside, and I'd mentioned that the next level of support here is this 200-day moving average. So this is a very, very important psychological level for the markets. Buyers typically either come in and save the day here at the 200-day moving average, or if it breaks down, usually it means there's more downside to come. RSI is trading below 50, which is generally not a good sign, and MACD is negative as well. And you can see in this short-term kind of zone, we've got this lower highs, lower lows kind of downward trend here. So if this 200-day can't hold, now it could whipsaw down in a single day and shoot back up. And that's the part two of this episode. First is the war and the impact on the market and the uncertainty it creates, along, of course, with the oil prices. But we also have another wild card, which is Trump. And Trump can get on the news or send out an X tweet or whatever, and and send the markets completely up again. So it's very difficult to trade with a president that's so forthcoming with information. So we want to be a little bit careful, not put all our eggs in one basket or the other as far as going all cash or staying all invested. We just want to kind of nip and tuck and take some of the risk off the table. There are pockets of the market that are doing well and pockets that are not, that are doing worse. So, we want to kind of slide into those types of positions that are a little bit more defensive in nature. But if this 200-day moving average gets broken to the downside and can't recapture and climb back up relatively quickly, then I see another about 7.2% downside from here, which would essentially take us to the previous high of the last run. So we want to just watch this very closely and act accordingly. So other signs that I look for, of course, is the 5-day moving average breaking down below the 100-day moving average, and it has. Just barely. So, we don't want to get too trigger happy here, but it's kind of a very, very big warning sign. And then we've got a little trend break here as well. In the last chart here, I'm going to show the S&P 500 on a weekly basis. It takes some of the noise out of the market, some of the day-to-day swings, and you can see that the trend line is still heading up, and that's good. So when the trend line starts to roll over, that's usually not good. So it's kind of mixed message right now, but the RSI has broken down below the 50 on the weekly, so that's definitely a warning sign. Now, previously when that's happened, you can see that when it drops down below the 50, it can pop back up. But if it can't hold it, then and the RSI stays negative, that's just not a good sign. So we're watching this. It's a little early in the game to make any real major gut calls on positioning to a large extent, but it is definitely something that we're watching. So in wrapping up, as you can see, the market will swing based on a lot of factors, and so we just have to nip and tuck a little bit here and there, protect where we can. But if we get a solid breakdown below that 200-day moving average, it usually doesn't spell good news. So we'll keep our watch. But if you have any questions, give me a shout. I'll see you on the next Markets in 5.